Hey everybody, this is Brian Belley, and welcome back to another week of the Kingscrowd Podcast. I am your host, and as I am each week, I am joined by our two senior investment associates, Léa and Teddy. Welcome back to both of you. This week, we're going to be diving into a deal review called Foment Bio, which is a non-viral gene therapy company. They are raising on StartEngine, and Teddy's going to be presenting that. And in addition, for this week's chart of the week, we are diving into the data around the equity crowdfunding deals across the country and how much capital is being raised and invested by city and state. So this is going to be showing where each of these companies was established and where their principal place of business is. Let's get into the first chart for this week. So Léa, I'm going to turn this over to you. Léa has done a great job assembling all of this data and basically is going to be presenting the findings from the amount of capital raised by city and state. So Léa, take it away.
Yes, this is a very exciting chart because this is the first time that we can not only see how much money is raised by startups in different states, but also in different cities. So this first chart is showing the average amount that was raised by startups that started raising after January 1st, 2024. And what that tells us here is that, well, the first thing with average is that obviously you kind of have a couple of outliers, right? For example, you have Oklahoma that raised about $3 million in average, but because they only had 2 deals. But if you look at the other states, you kind of see that states like California, for example, are going to be raising around $600,000, Nevada about $1 million each $1,000. We stay with average that are relatively close to what equity crowdfunding's averages, but we also see that the population centers, so the Northeast, the West Coast, Florida, the South, kind of have the states, the most populated states kind of have the highest average of money raised, which means that there probably are more successful startups over there, startups that are just doing better in equity crowdfunding. And what is really interesting with the city is they kind of 3 really concentration pools of money raised. So the Northeast, obviously, we have a lot of different small cities with small averages amounts raising on average, but it's just across so many different cities that the actual quantity is pretty big. Then we have Florida, which is really, really overperforming in terms of averages. And we have the coast of California as well, with big concentrations in the Bay Area and around Los Angeles. So that is for the first chart. The second chart is showing us the sum of money that was raised on that same time frame, so in the last 18 months. And here we can really see where the biggest amounts are. So as you can see, California is not surprising. So many startups in here. It has been just couple $100 million in the last 18 months, with also a lot of deals, right? That's why the average is relatively low at 600,000, but the total is pretty high because there is more than 250 deals. What was actually really exciting for me was to see Las Vegas. There's just so much money that has been raised in Las Vegas, and that's really just a dot lost in the middle of the desert. It's not really something that I was expecting. I didn't know Las Vegas was a big startup scene, but it kind of seems that there are probably companies here that have been very successful, and that really shows the power of equity crowdfunding, because wherever you are in the country, you can raise money for your startup. So Teddy, Brian, tell me, when you see these charts, what does that inspire you?
Yeah, one of the quick things I'll just add in, unfortunately, I see a couple of states that look blank here. So I'm guessing these are the Dakotas and West Virginia over here. So I don't know if there's any others that are missing. In terms of just the ability, though, for equity crowdfunding, and that means there could be debt crowdfunding deals, right? I guess we should make that caveat. These were equity crowdfunding deals over the last 18 months. So there may have been debt crowdfunding deals, but one of the things that you hear about a lot is this kind of I'll say between the coasts, right? Usually in East Coast, West Coast, you hear there's a lot of activity. So that's typically kind of in the Pacific Northwest around places like Seattle with startups, all of California, as well as, the Northeast and all the way down to Florida. Those tend to be really powerful. It is good to see that there is some deal activity, in some of these other locations. So obviously this is around probably Denver, Colorado, a little bit in the Midwest, huge representation from Chicago here in the Midwest, Texas as well. But also, there's some raises in most of the states, and there have been raises in all 50 states since the start of Reg CF, of course, and Reg A. But, even Alaska a little bit here being represented, Puerto Rico. So it's pretty interesting to just see the diversity. And I think the other important thing to remember is this is just where the businesses are based out of. So the people investing in these are coming from all over the place, right? And not just the United States, but even sometimes outside of the US. So it's exciting for me to see a little bit of that graphical representation of just these are where all the businesses are that are being supported, whether they operate online or in their local communities. But I'll hand it over to Teddy. And Teddy, any takeaways or quick takes from your end?
Yeah, it's these hotspots, not overly surprising. Like obviously San Francisco, they have all the biggest VC firms are there: Sequoia, Anderson Horowitz, Accel, and Silicon Valley is just kind of the hub for engineers and AI and everything. So not surprising there. There's, if you zoom in a little bit, not seen, but like Boston, Massachusetts, Cambridge area, very hot spot for some very large health biotech companies like Biogen, Moderna, Vertex, Sanofi, all based out of Boston. So, we see a lot of healthcare. A lot of health tech, healthcare and biotech VCs based here, just due to the kind of concentration of talent here. It's proximity to MIT, Harvard. So definitely see a lot of that. And then Texas, we obviously know a lot of companies starting to move their headquarters over there. Tesla is headquartered there now. Oracle, Apple has a large campus there. And then Seattle, we see, obviously, that's the home of Amazon and Microsoft. They're kind of, so obviously a lot of startups kind of either spinning out of there, employees kind of spinning out of there. And so, yeah, anyway, point being, not overly surprised by the hotspots of this chart, but definitely cool to see that even in the equity crowdfunding space, the kind of same areas seem to be a ground for these companies to start out of. So,
yeah. And I'm sure even just taking a look at the chart, like you mentioned, when you zoom in, even if you were to take all of these around kind of the Bay Area and aggregate them together, that probably becomes a much bigger circle in the map. So if you look at this, you might be like, well, why is Las Vegas bigger than San Francisco? Well, that's just San Francisco. But if you include all the other Bay Area places like around that, right? And also, Southern California definitely representing here as well.
Two other things that come to my mind. The first is that I did the similar chart a couple years ago, and Hawaii was actually one of the states with the highest average. So right now we're on total, but it used to be average just because they have 3 outliers company that outperform. So when it comes to average, it just really depends on what are the deals every year, and that can change. The other thing is that, as you mentioned, there are actually a lot of startup raising online across Denver and Boulder in Colorado. We have, for example, Ajna Biosciences. A couple of years ago, I remember having Rasa in Boulder. That was also a pretty successful deals. And there's a lot of deals also related to kind of that healthy lifestyle or alternatives products. So Ajna is around cannabis and mushroom for drug development. Rasa is around adaptogenic mushroom tea. And it's also a place that we've been seeing that is very, very dynamic and where companies actually are raising quite a substantial amount of money over there.
Interesting. Yeah, I know there's a lot of good data on this chart. So thank you, Léa, for putting this together. And we'll be definitely looking forward, and probably will be producing more charts like this. So if anyone who's out there watching or listening has a chart of something they want to see similar to this as a heat map or based on city or state or anything like that, feel free to definitely reach out, let us know, drop it in the comments. Awesome. Well, thank you, Léa. Let's move on to our next segment. So the deal review that we're going to be going over today, it's been a few weeks since we've done a deal, is going to be Foment Bio. This is a company, again, as I mentioned, it's a biopharmaceutical company that's currently raising on StartEngine. They're doing kind of a novel transient gene therapy to treat cardiometabolic dysfunction. I'm going to hand things over to our resident expert here, Teddy, to tell us about Foment Bio, the opportunity, and kick off the discussion. Teddy?
Yeah. Thanks, Brian. Yeah, so like Brian said, Foment Bio developing a new type of non-viral gene therapy, and if that sounds sort of familiar, it's because Siren Biotech is a company that we invested in from KC Capital. We've featured a number of times, and one of the companies that I'm most excited about raising. And so Siren Biotech, they have developed a viral gene therapy specifically for delivering not cancer curing, but basically delivering cytokines to the site of brain tumors, and though your body will eventually use those to basically cure yourself from cancer. That Siren Biotech going through a very long FDA approval process, but they're well on their way, very well funded. So what Foment Bio is doing is they are using non-viral gene therapy to specifically treat diseases like heart disease, kidney disease, and wound healing, basically. So because it's a non-viral gene therapy, it is significantly cheaper. They're using off-the-shelf gene therapies. So, much, much cheaper than what Siren Biotech is doing. And just to kind of give you a sense of scale, so over half of Americans live with cardiometabolic disease. 6 million have chronic heart failure. 37 million have kidney disease. And yeah, like I said, they're instead of using viruses to deliver these payloads, like traditional gene therapies, Foment uses off-the-shelf plasmids. So similarly, you can kind of think of them as little kind of software packages, kind of once injected, they give the body's own cells temporary instructions to make regenerative exosomes. So these exosomes are particles that reduce inflammation, repair blood vessels, and basically help organs heal. So in terms of their two therapies that they have, so Foment Bio's first drug, FB101, they have treated 200 patients across multiple phase 2 studies, have seen very strong efficacy results. And what they found is with this drug, if it's injected directly at the site of an injury, so whether that's a heart disease, kidney disease, or a wound, they see very strong efficacy for repairing whatever it is that's wrong. So this is obviously very positive clinical data. However, the issue is when you kind of get into treating issues with the heart and kidneys, it is not the most efficient, I guess you could say, to have to deliver the drug directly at the site of injury, and it's not really doesn't really scale in a way that they would want it to in terms of getting big pharma on board and things like that. So they are developing their second generation therapy, FB201, which is kind of bypasses that need to deliver the drug directly to the injury site. So it can kind of, you can inject it into a thigh muscle and it'll trigger that exosome that can travel to the heart or the kidneys. And so in preclinical studies for FB201, which is kind of what they're focusing the most on now, it actually outperformed their first asset, FB101, in improving, basically improving sites where revascularization is necessary, reducing scarring for the wound healing indication. But so those are the kind of two assets that they're developing, and what they're doing that's pretty unique in terms of commercializing these drugs is they are going after the companion animal market first for this FB201, where regulatory pathways are much faster. And their plan there is to really partner with a top animal therapeutic company and kind of bring it to market via kind of royalty licensing deal with one of these large animal therapy companies. And this FB201, the fact that it doesn't need to be injected directly at the site of injury, so the heart or the kidney, because with animals, that's very also like it's even harder than humans to do. So being able to inject it in, an animal's leg or back or wherever it might be is a lot easier to administer the drug to a cat or a dog, and is just a much better commercialization asset for this market. And kind of from there they'll kind of move into getting it approved for humans, but developing it for the animal market first kind of gets them revenue a lot quicker, and they'll basically use that revenue to bring it to market in humans. So anyway, so that's Foment kind of. I guess probably not. It's not that high level. I was kind of got in it there, but
it's good. That's what we're here for. Our audience loves getting into the weeds and looking at the data. So.
But so this is Foment Bio. We're in the later stages of considering it for KC Capital. It's kind of an interesting one. We've never really seen a biotech company focused on the companion animal market. So, curious, Léa, Brian, your thoughts on this one?
Kind of go back on what you just said. For me, a lot of drug companies, more than medtech, are just extremely risky. They need to develop the drug, it needs to work properly, it needs to be FDA approved, then it needs to be accepted and actually adopted through the medical community. In this case, they have a product where they're going after the animal market first. And that was very exciting to me because it looks like they will potentially be able to generate revenue without having to wait for years for that drug to be approved for humans. So that's kind of the one thing that really differentiates with this deal from any other that we've seen before, and to me should make people at least consider investing.
Yeah, and I'm showing, the deal page here on Kingscrowd. So again, anyone can head over to kingscrowd.com, check out our ratings on the deal, dig into company analytics. So again, you can see all the different details of the company, the team, the industry, the year it was founded, as well as financials. So at Kingscrowd, we pulled the past prior 2-year financials. So you can see we have fiscal year 24 and fiscal year 23, as well as when Teddy and Léa are doing their different research on all these companies, they reach out to the founders. And so we get updated things such as runway and monthly burn. Teddy, one of the things that stands out, and understanding that, it's in kind of an early stage pharma company, so we know they're going to have to go through FDA trials. That's why they're getting funding. But what can you say in terms of their current monthly burn and their current runway if an investor were looking at these numbers?
Yeah, so obviously with biotech, medtech companies, because of the time to commercialization is generally quite long, burn, cash on hand, runway are obviously of utmost importance. So Foment Bio, they clearly do need to raise quite a bit more funding in order to get this commercialized, even in the companion level market. However, what de-risks it a little bit more than a typical biotech company is because they are going after companion animal market first, they're going to be partnering with an animal therapeutics company that will actually be financially kind of backing the studies required in cats and dogs to really kind of get this to market there. So Foment Bio, during that process, I forget the FDA equivalent for the animal side of things, but the company that they do end up partnering with, they will be really kind of doing the study design, executing the animal studies, and using their resources to get this drug to market and commercialize it themselves. And Foment Bio will be a lot of supporting and consulting for the biological activity of the drug, the study design, and kind of just working hand in hand with this animal therapeutic company to commercialize it. But it's a much more capital efficient, capital light method of commercializing a drug because they don't actually have to Foment Bio doesn't have to put in all the resources themselves to kind of get it approved in the companion animal market. So that is kind of a unique point of Foment Bio. Again, that still doesn't mean they're not going to have increased burn requirements in the future, especially if they do end up getting to the point where they want to commercialize this in humans. Ideally, they will have enough royalty revenue coming in through the pet market that it'll kind of fund the human trials. But again, pretty unique kind of profile financial profile to analyze this one from.
As an investor, Teddy, if I'm investing in this, obviously it's really early stage. They got to kind of go through these trials, get approved. What's a typical type of outcome for this type of company? Are they looking to get acquired or license it or IPO or, all of the above? What would an investor perhaps look for as a potential exit opportunity here?
The majority of biotech startups, you are investing in the hope that a big pharma or a larger biotech company will acquire the IP of the startup, and they'll be the ones to kind of bring it to FDA approval, commercialize the drug, whatever it might be. With med tech devices, it's a little bit different because they go through what's called a 510K clearance, which is much quicker and easier for a startup to actually commercialize a product. But when it comes to biotech, getting it approved in humans is a massive financial time sink for both of those things, and it's very, very difficult to bring a drug to commercialization in humans without having the resources of a much larger big pharma company, either that you're partnered with, which is the direction that Foment Bio I think probably wants to go once they do move into human indications. It's either partnering or being acquired by a big pharma company. That's kind of the ideal outcome. And once a drug is commercialized, that's really where the financial returns come in. And if Foment Bio, for example, if they do not get acquired, but they're able to get the drug approved in humans, the company's value will obviously go up significantly. If they're acquired before they're actually commercialize the drug, which is generally what we see, obviously the returns are much lower because the drug isn't actually in the market yet. So they're really what you're getting a return on is the future growth that is being baked into the acquisition price. So it can get kind of complicated in this space, and outcomes can vary really widely. We saw with Oncolize, they got acquired very early, and because of that, the returns weren't like enormous for non-accredited investors. I think it was like a 10% return, and accredited investors got shares in the acquiring company. But anyway, it can really range, kind of even more so than your typical kind of software company. With biotech, they can get acquired at all different stages of the company life cycle. That adds to the risk profile for sure.
Well, check it out. If you're interested, head over to Kingscrowd, read that analysis. Well, I want to make one quick plug as well. So as I think everyone or a lot of people are already aware, but Kingscrowd is going to be hosting our first investment crowdfunding week this year. So make sure you head over. It's going to be, save the date right now, September 29th to October 2nd. And we are going to be opening up registrations. Essentially what this investment crowdfunding week is going to be, we're going to be inviting all of the industry experts for 4 days of live pitches. We'll have market insights. We'll have great interviews with founders, exclusive access to the Kingscrowd team, to the founders, and a whole bunch of great resources. So make sure you head over there and check that out. Also, if you want more great data-driven insights like what we've been discussing here on the podcast today, we have a free newsletter each week. It goes right to your inbox. Head over to newsletter.kingscrowd.com. We will sign off for today. Until next week, we'll see everyone back here then. Thanks, everyone.